Once again, a very good evening and warm welcome to all the participants. And as you know that I welcomed you for the monthly con call for the month of August, and our last call was on the 2nd of July. And maybe after 45 days, we are doing this call. And by now, as you know, that we have launched after the 8 years of very active journey with the equities and the debt funds. So we have launched our first FOF and the first ETF. In this monthly call, post the market outlook, we will also cover the silver ETF and understand the ETF from the perspective of timing of the metals in the product. So maybe over to you, Sandeep.
Yeah, thanks, Anupam. So, very good evening, everybody, and welcome to our August month call. Let me just briefly talk about market. Then we talk about silver ETF and why, even in the passive product, we like to bring the active aspect, how timing is the essence for that product also, and how well we are able to time the ETF product also. So, let's come to the market first. Okay. Okay. Before we go to the market, let's briefly talk about the performance part also. And very interesting data. We have just compiled some of the data for our internal presentation. I thought we'll be able to show you. What was very interesting that obviously from 2018 when we acquired Export and 2020 onwards we implemented our VRT framework. But what is very important in that last 7 years of journey in that sense, or 9 years of journey post acquisition, the way we have performed, even it has really supported our 10 years and 15 years performance also. What is very interesting to find, we did some of our internal analysis that in last 10 years, okay, 100% of our schemes have beaten the benchmark. It's very interesting. It's not we don't manage one or two schemes. This is silver ETF with 36 schemes, so it's a reasonably well diversified portfolio. In last 5 years, 83% of our scheme has outperformed the respective benchmark, and last 3 years, 89%. If I have to look at last 1 year, 88%, and in last 6 months, has been very challenging for the market. 100% has beaten the benchmark. So that's a good track record from the beating the benchmark itself. Now, if you really look at some of the schemes which has completed 3 years of performance, we are trying to showcase what sort of returns we generated in last 10 years. If you really look at closer to 20% mark, many majority of schemes have generated the CAGR return, which is decisively higher than the benchmark number. So you look at the what sort of alpha we have generated. This is our 10 years performance. And if I have to look at the 5 years performance, it also give you a similar perspective, what sort of CAGR we have generated over and decisively beat over the respective benchmark also. Similarly, if I have to look at even 3 years performance, because in a mutual fund schemes, we always talk about, let's look at the longer term, the consistency aspect, 10 years, 5 years, 3 years, as compared to looking at just 1 quarter, 1 year. So we are trying to even show you a longer period duration that in 10 years we have done very well, 5 years we have done extremely well, 3 years we have done well. And even last 1 year, which has been very challenging for the industry, I look at what sort of returns when the industry benchmark returns are flat to negative. So some of the schemes have given as high as 18% return, 15% return, 13% return. So it's a very meaningful, even the flexi cap has given an 11% return. So it's a very decisive beat over the benchmark. And obviously, we have done outperform significantly the category element, and most of the schemes are showcasing in the top quartile. So this is a small perspective. Now let's come to the even look at the 6 months performance. Some of the funds have given like 27%, 21%, 19%, 18% return, which is a very decisive move. If you really look at least 90% schemes are above 6.5 to 27% return, where benchmark returns are hardly anything. So now let's talk about before we move to our market outlook, I also want to talk about the QSIP presentation also, performance. And frankly speaking, we'll be doing next week a call separately dedicated to SIF, and we'll also going to cover our other FOA which we are just launching, okay, or other launch yesterday. So even you look at our performance on the SIF side, okay, we were the first to complete our bouquet, all the 5 products which is required in the hybrid and equity we have launched. And if you really look at the active asset allocator, 14% return, 3 months. Okay. As compared to benchmark 0.17. So decisive alpha of more than 14%. If you really look at the equity 100, 14% versus benchmark of nearly 4%, 10% outperformance. Similarly, the equity long short, which is the flexi cap sort of structure which we run, a decisive beat of 5%, 9% return. Even the hybrid fund, which is a very low category risk, it has delivered 3.87 versus the benchmark of 2.26. So again, a decisive beat. Okay. Now, even you look at slightly longer term perspective, 6 months. 6 months, our X top 100 is given nearly 20.5% return versus benchmark of 2.27, beat of 18%. Okay. Equity long short, nearly 14%, a beat of 11.6%. Hybrid, the category, the benchmark itself is negative return. We are 10.97, 11% outperformance. So the decisive alpha has been created. I always talks about this could be a serious opportunity also, and maybe we'll talk about the risk adjusted return in the next uh, call, which we'll do in the next week. So now let's come back to the market. Okay. So it has been a challenging year from a geopolitical perspective. We have seen the battle which started in February is now 6 months have passed, has not gone anywhere. Though it has been subsided or diluted up to large extent, but it's not over. Russia or Ukraine battle is still going on. Israel related challenges in the Hamas area or the Palestine side also continue. So we are all living in a very complex geopolitical world and how well we can navigate. Now, if you recollect, right from January, we have been talking about the 2026 will be more, it's all about adaptive approach, adaptive asset allocations. In a dynamic environment, at least Quant is one fund house which has ability to rebalance your portfolio depending on the prevailing market conditions. So we are the first to adapt this thing, and that has been reflected in our performance in the challenging time, how we have performed. Now, the beginning of 2026, we talked about fragile 2026. These are some of the themes which we have recommended, and I just want to come and talk about where we stand now. Okay. Now let's look at from a market perspective. So on 1st April, we talked about India absolute outperformance begins from April 2026. And this is a time we talked about, it's a time to capitalize the opportunity, not get capitulated. And if you look at in last 4 months, market has worked reasonably well the way we have forecasted based on our predictive analytics tool. Now let's talk about since last 4 5 months has been reasonably awarding for market in general, at least broader market has done very well, though it has been tough time for the frontline indices, but we have done extremely well because we were able to capitalize on the timing aspect, which we said 1st April, things would change and we have deployed. So we are running nearly 96%, 95% sort of allocation, like 4 to 5% the cash. One or two schemes have also have 7 8%, but that depends on the opportunity. Now, when we talk about India as a theme, India suffered, if you look at last 2 years, particularly on the AI theme, which played out globally, and we were relatively weak on terms of. But the good news is that India is one of the few countries who has adopted AI very well. And we always say Indians have that edge in adapting something very fast. What happened post COVID, how the digital transaction has changed. Okay. Even our vegetable vendor has started using some of these things. Our parents never used to use some of these things. Now we are very comfortably. So now in 2020, post-COVID, we played very nicely anti-ESG theme, where whole world was talking about ESG, and we bought all sort of defense company, power companies. Okay, so that thesis played out beautifully for us. And beginning 1st April, we have been saying this is the anti-AI theme which has begun, and that's one of the reason we believe Korea as a market has peaked out from a medium-term perspective. Something similar situation is there in Taiwan. And what I believe, either last week, US market has also peaked out, or they are in the final stages of peaking out, which means that anti-AI theme will gather momentum. And obviously, if this themes gather momentum, then India should be the biggest beneficiary because we have suffered a lot, both in absolute terms and in relative terms, in a big way. If this reversal happens, then a lot of FIs will return to India, which is already seen the selling exhaustion happen by March end. And now we are seeing at least the FI selling is largely done and some sort of buying has started. Even if you look at the domestic side also, the good news is that the domestic flow on the mutual fund continues to remain reasonably robust. I'm not looking on month change, but if I have to look at a YY change, it's still doing very well. So what let's talk about now. So we have seen 3 or 5 months of reasonably good up move. Now we are seeing some signs of consolidation in many frontline indices and SMIT stocks, particularly SMIT category has done very well. Now we are not turning negative. What we are highlighting that next 1 or 2 months or maybe a quarter perspective, if I had to talk about, I expect market to consolidate, which will be healthy for the market for the next level of takeoff. So consolidation is talking about. The pullback rally will continue in the most neglected and weak value stock. That's another thesis which we believe has played out and will continue to outperform. Now, the precious metal space, why we are launching was silver ETF. So one of the key reasons we believe silver buying opportunities re-emerging, I'm going to talk about in the silver presentation. Let's talk about in April, we said that gold will underperform the Indian equities, SMID in particular. We still maintain that view, despite gold and silver have recovered a bit. But if I have to look at on a relative basis, precious metal, particularly gold, has potential to underperform the SMID category or market Indian equity in general. So which means next 3 years perspective, Indian Nifty stocks or Indian equity stocks should logically outperform the gold. And this is a very important statement which you are making because a lot of people are very much fascinated about the gold, particularly when markets become challenging, people tend to shift there. And if you really look at that thesis has not played out this year also, and both precious metal have corrected sharply, when silver corrected more than 50%. So if I have to talk about now from what exactly thesis we're going to talk about. So we are very clearly looking at a portfolio consolidation phase. Okay. And what is important to understand is that our relative outperformance has potential to expand. Now it obviously looks like a very far-fetched thing because a lot of people have turned so bearish. And this bearishness is so deep rooted in our subconscious mind that we have started ignoring the good things also, which is playing out. I think I always talk about the markets are always absolute and relative both. You have to look at relative perspective also. But we as an investor has of largely looking at absolute return. And that's for reason a lot of people get frustrated. But if I have to look at from a global perspective, if NDI themes will gather momentum, then a lot of money will shift from Korea, Taiwan, US towards India. And that's the reason I'm saying India could be the sole beneficiary of this ANT theme. That's one of the reasons we have increased our technology exposure in our portfolio. We will talk about that. We strongly believe that P contraction in the new age technology has begun and it will gather momentum. And the real challenges which I'm seeing, or the biggest challenges happening on the block and bulk trade sort of thing happen. People stand, particularly institutions stand in queue to participate because a lot of people think the impact cost is significantly low or at low or rather no impact cost. You are able to get size because a lot of people are sitting very large amount of cash on the mutual fund fraternity. So they are trying to deploy it. But this is the area where I'm seeing concern immediately after the block happens. In a day or two, stocks started trading at discount to that price, which means obviously we're participating at this level. Investors are not going to make money. Here I am concerned because extraordinary supply is coming both in the IPO side as well as on the secondary market sale. I'm more concerned about secondary market sale coming from the promoters, large family office, and company itself. Even some of the company don't need capital. It becomes a now a healthy trend to say I'm a debt-free company. When you have very decent operating leverage, as a time to optimize through financial leverage, but we have forgotten that part and everybody wants to raise money. That's my area of concern. And there's a reason we rarely participate in these things, or maybe very selectively we have participated. So this is the way. And the most important thing about that, Indian liquidity is still improving, which is the good news right from April onwards we are seeing. Similarly, the risk appetite, which collapsed in the month of March 2026. And as I look at the last month data, it has further expanded. So, which is the constructive background. That's the reason we are more constructive on the Indian equity as compared to global equity. India is much more safer right now. And there's a thesis. So, if I have to really look at in terms of sector performance, as you are aware of, we as a house are pure active money managers. And one of the very recent presentation in FlexiCap, we have tried to showcase how actively we manage as compared to industry, and we don't mimic the benchmark, we don't hug the indices, and hence our volatility will be always on the higher side. But when cycle view in your favor, you are able to outperform decisively. We have been quite bearish for banking stock for a long period of time. In last 4 years, we have talked about how the underperformance is there on the particularly on the large private sector banks. We as a house believe that asset management company has potential to attract more deposit from the banking channels, and hence asset management companies are now becoming as a core to our portfolio. NBFC is also something similar. We believe they have potential to outperform the banking, and they have done so. We have increased our exposure. We are now looking at government again focusing on the large infra projects. Okay, interest rates has been reasonably under control. Energy is a theme which I always talk about, linked with data center themes. So maybe till 2032, 33 also, we think a clear visibility energy, irrespective of whether market corrects globally on behalf of NTI thesis, but power consumption will remain on a higher side. So we are more bullish on the AI implementation. Somebody has to implement this AI tools for the large enterprises. So telecommunication space, pharma generic, we have been very optimistic for a while now, has played out very well. And obviously some of the neglected territory like hotel gives you an opportunity. Media entertainment, though options are very limited. This is the area which we like, okay, which try to showcase in our portfolio. Now, if you look at in terms of our positioning, how exactly we have done. So we have added in last 2 months, particularly last 3 months, particularly we have had select large cap IT names, which has done well. And despite last few days a small correction, I think they are also rally sharply so they can correct. So we are more constructive on IT because they reached down our neglected and hated zone, which we try to identify. We have been there from September 2021 on the tech space. Similarly, on the energy stocks also, we have increased selectively our exposure. We have further pruned down our banking exposure and added NBFC and asset management companies, the theme which I just briefly talked about. We have also increased some exposure in pharma and healthcare space. We have reduced FMCG and consumption names. Given the El Nino issues, given the turmoil which is happening on the trade side or the on the logistics side, it's a deliberate call to have relatively underweight on the manufacturing as a sector. Though I will be candid enough to say the results was far, far superior than best of the analysts' expectation, which means there's no letdown on that front. But still, being as a risk manager, we want to playing safe. And we are again now, April, we talked about SMID outperformance. Now we are saying they have done an extremely good job. We are not turning negative. But we are saying that we are rebuilding some of the large gap because the gaps between both from a valuation perspective and some of the parameters which we look at, gaps are reasonably large. So margin of safety by default becomes more of the large cap. That's the reason in last 1 week in particularly, we have tinkered our portfolio and trying to increase. It's not like we are negative on the mid and small. We are still very constructive, but on the relative opportunities, there are some of the large caps are trading at fairly good attractive valuation and liquidity is very high. So we have taken some of the exposure. Now let's come to the some of the products which were launching. Now you've seen that right from 2018 when we acquired that Escorts Mutual Fund, we talked about active as a process. And frankly speaking, we as active manager has done extremely well in this period. Now, being as a manufacturer, we are also offering gradually expanding our basket, which will including the ETF side, fund of fund. Fund of fund will be a very interesting opportunity because so really active money management. In fact, it will be more dynamic way which suits our thing, and that's the reason we are saying that quant is not just active, now active D and passive D. So we will be offering both the product in phase manner, but within passive also, we as a house try to optimize in terms of timing. We always say timing is essence. And one of the reasons why we are launching silver now, because we felt silver data points are constructed from a opportunity to buy. So one of the thesis which we're talking about. So we just opened both the product yesterday, income plus and arbitrage product. This we will covering in depth in our next week rather conference call. We're going to talk about SIF and this. And in today's presentation, we just want to talk briefly about silver ETF. Why silver ETF? Though there's not any difference between any of the existing product, but how uniquely we have trying to position. And obviously, it is closing tomorrow. So it's August 19th, 3 days we are able to open up this product. Now let's look at uh, so obviously we are the first CTF from the quant side. We are very nicely showcasing as a tagline, Sadal Nivesh Smart Soch. Okay, very simple, smart Soch sort of thing. And this is the new logo. As you are aware of that every scheme in quant mutual fund has its own logo apart from the quant. So this is the ETF logo because if multiple ETFs are coming, it is difficult to have separate logo for each and every scheme. So we have, and for the category itself, we launch a separate logo. And now an interesting aspect is that the way our approach, so we are saying the silver is not just jewelry anymore. Okay, obviously it has lot many industrial uses which we are familiar, but in today's world, when a lot of data points have changed, particularly on the AI side or data center related things or the EV side, usage of silver has actually increased significantly. So high probability of some amount of shortage is there. And even globally, people are moving away from gold to silver. Even China, during their festive period on New Year's in the month of February, now it's become a trend instead of gifting gold-related thing, which has been an old tradition in India and China. Silver is gathering momentum. So we are trying to give you perspective. Now, the essence part, if I have to say why now, okay, it's an important thesis why we are saying now. What's so different in this passive product, okay? Now, if you really look at from peak in January when we talked about this precious metal will correct sharply, we talked about 54 levels and worst case scenario 40 levels also when it was moving around 114 and 121 levels. It has corrected more than 50%. If you look at the average ETF return in last 1 year, it's negative 90%. Okay. It give you in last 1 month, you see is 9%. Okay. And one of the reason why we are launching this product and which we want to explain through a small presentation out here. Now let's understand the skill set which we have in terms of macro capability or through a predictive analytics rules. Okay, we are talking about a durable bottom. We are not talking about trading bottom. We are saying durable bottom for silver, both in terms of price and timeline, should materialize in second half of 2026. Okay, so basically, when we launching a passive product also, we are saying the timing makes a lot of difference. It's a good entry point to increase your silver exposure. If somebody does not have, it's a good time to add. Now, this is a small gold silver ratio, and we're looking at some of the comics data related to how exactly some of the data point which we're looking in terms of the 6 months average sort of thing support. If we look at this, is more from a general perspective, we want to give you is some of the area psychological supports have re-emerged out here. So it's looking nice on paper also, data points. Now, what is important? Our credible track record in getting the precious metal cycles right. And this is where I will spend few minutes. Now, let's look at a lot of people are familiar. We wrote a book called Being Relevant in 2018. We published this report. And this is the page we are trying to showcase from the Outlook page of our book, Precious Metal Outlook. Okay, a golden dawn. Now, what is important in in this box we have highlighted? We talked about the climatic bottom in final phase of gold. This thing will happen around 23. And then we talked about gold will start its multi-decade rally in late 2024 or 25. You were surprised to see September 2024, the precious metal started rallying decisively. Okay. And this is what something which we have written in 2018 that this cycle will unfold from late 2024, exactly play out. What is the big picture we're talking about? When by 2047, when India achieves the Then our demographic cycle peaks out by 2047-50. Indian household emerge in the wealthiest globally. Okay. Because we expect by 2047-50, the precious metal cycle is going to be next level, and both gold and silver should do very well. Maybe in certain phases, silver will actually outperform gold. Okay. And this is one of the reasons we are talking about by 47, India will be the wealthiest country in the world in terms of not in terms of GDP, but in terms of wealth accumulation at the hands of real citizen or the investors. Okay. And this is a thesis which we're talking about. Yes, with the help of predictive analytics tool, we can visualize how it unfold. Now let's talk about, that's a very big picture. Let's talk about what we talked about in the beginning 2026. The beginning 2026, we talked about that extraordinary volatility will be there in in the precious metal space. And we will say that you will not be surprised if you start feeling like precious metal are acting like a cryptocurrencies. And that's the thesis which we said in January. In 2025, we highlighted silver will outperform, which did. And something similar we expect that in second half of 2026, when we're seeing gold or precious metal making a bottom and silver in particular, silver will again outperform gap, but gap should be narrow. It will not be as high what we saw in 2000. Now, if you really look at, we talked about gold prices at the range will be 44 to 3800, 52 to 5500. We sold at 5500 our exposure, we cut down and we touched 3800 nearly. 44 is something, 44 it came and closer to below 4000 also. I still believe this is a range. It can retest 3800. I'm not ruling out. That's the reason I'm saying. But silver, if you look at here, 170 to 27, we sold around 14 level. We touched 55 levels and now it's closer to 64 levels. Excuse me. So this is the other area. Now it becomes impossible to time exact bottom. And that's the reason we are saying that in January 2026, we said second half of 2026, it's closer to this mark. And hence we are launching this product. And over a period of the next few months, if you accumulate silver now, it should be a very big win trade sort of thing. And I think good diversification from equity perspective in a turmoil world. So we have a reasonably good track record. And this is a multi-asset fund, how we have still gold. And if you notice from April 2025, we have only silver exposure in our portfolio. Okay. So with the peak, we were 30%. And this is the data on the month-end point of view. And then in January, we cut down our silver exposure. And since we have to maintain 10% minimum exposure towards gold, we have moved towards gold. And if you see in last 2 months, June, July onwards particularly, you have seen our silver exposure is also coming. So we are adding silver in our exposure where it was zilch for last many months or maybe 2-3 quarters. So important point of view, okay, this is what we did. And on a 114 level, we have shifted towards gold. And since we have a compulsion to maintain that part, which is not the case in SIF, so we have, and from June onwards, we started rebuilding our exposure because we said second half, that is July 2026 should bottom out. Now, obviously, it has a lot of link ingrained in our tradition. Okay, Indian household, we are hold 41% of silver we consume. Okay, and this is a tonnage of 48,600 tonnage we absorb. This is a good data points to have, and this is about India in terms of which is one of the biggest consumer of silver and precious metal also, and the gold also. But within precious metal, if I talk about specific about gold, the number is around 41%. Now, a lot of things are there. Silver from uncertain thing. If you actually try to see how the uncertainty index plays out globally and then try to say with silver, you get some perspective, though it's not perfect correlation. This is something important we have tried to highlight in various crises which unfolded in last, let's say, 20 years or so. Will give you fairly good perspective how Nifty 50 has done, how Nifty 500 has done in that period, and how silver has done. Okay, so even the financial crisis GFC one, which we generally refer, Nifty fell 40%, 500 fell, but look at silver up 31%. European debt crisis between November 10 to December 11, nearly 30% fall, silver were up 36%. Chinese market crash happened between August 2015 to January 2016. We were up 3%, where markets were down 16%. Similarly, even if you look at Brexit, US election, or the fate which happened in the 2016, if you all demonetization phase happened, and silver has done something similar as compared to equity market. So we are don't trying to give you perspective only about performance. We'll give you a fairly good perspective, even how recently it has done. If you really look at out of 8 crises, okay, silver has given 4% return. If you look at average it out also. So in every crisis, it has a potential of generating at least positive alpha, and maybe on a relative basis have done far better. Now, if I look at the correlation with Nifty and Nifty 500, very interesting. With Nifty 500, the silver correlation is only 0.414. With Nifty 50 is 0.15. So obviously, it's a clear indication we have low correlation when in equities, a great diversification from the market participant point of view. Now, this is the interesting aspect you have to understand from a rupee perspective, since rupee is also depreciation, though that's the reason Indian silver in rupees terms has actually outperformed silver. This is how the return has been for silver 1 year, 96% CAGR, 3 years. This are some of the numbers which we talk about. Now, obviously, January it has fallen 43 to 50%. Now it's 43, but at the peak, it has corrected more than 50%. Now, what is important to highlight it, if we factor the devaluation of rupee, you're seeing how silver has done in gold terms, in USD terms, and you compare rupee terms. So obviously, because of devaluation, the, ru- the silver in rupees term has always outperformed the silver in the gold term. So maybe a good hedge in that perspective also. Okay. So important data points. This is how silver demand has outperformed the supply side. This is the way demand is, and this is supply. So these are reasonably large gap. Though the gaps have shrunk, and this is in prices also corrected here. The gaps were the highest, and the prices also reflected up to that extent. Now, this is a small comparison what we want to do from the holding the physical gold from a safety point of view and the security headache you have as compared to holding quant ETF. I distinctly remember when we started getting the demat shares, okay, there was a lot of psychological resistance. We were so used to physical shares. And there's a trend which I'm seeing, and I think something similar and will unfold very quickly in next 4 to 5 years. Even on the mutual fund side, everything will put it through demat things only, so life becomes easy. We're just trying to give you entry exit perspective, taxation perspective, and ease of doing as compared to physical ETF. So we're trying to just give you a comparative thing. I'm not getting into very specific details. Okay. Now, obviously, it's a easy instrument listed on the exchange. Okay. Market makers are there. They do provide two ways liquidity. Okay. So from a ease perspective and security perspective, silver ETF makes sense. And that's the reason we are launching quant silver ETF. Now, if I have to look at from the benefits point of view, obviously great diversification, rising industrial demand, inflation and currency hedge also we manage, and obviously has a long-term potential from the wealth creation perspective. So it fits multiple bills. Okay, now the key aspect as compared to any mutual fund scheme, you must have a demat account. Demat is the important thesis which you want to talk about. And this is the important comparison if you own a physical gold versus the silver ETF, how the capital gains will change, how the holding structure. This is some of the area which we have tried to explain. Again, a very simple manner. It's a nicely explained and self-defined slide. This is without getting into complexity. We just want to give a lot of people have curiosity how exactly it converts, whether my silver is safe or not, whether it is insured or not, whether it is there with the proper warehouses, the custodian involved, everything the from a safety perspective that I'm giving you to your silver, or basically my saving to you in the form of silver. But where's the security? This is one thing is there, and this is meant for all the ETFs in this country. So it's the most important myth. A lot of articles now comes in global markets that ETF is only on paper. These gold and silvers are there. In reality, is missing. It's not part of the in their storage. But here, the physical audits happen. Okay, a regulator also monitor these positions. We as a firm monitor. So there's a custodian of thing. Even the vault operator also do their audit. So it is well defined. Every penny which you invest is backed by physical silver. Instead of you putting and managing the security, the vault guys are managing on your behalf, and we act as a coordinator in that sense on offering this product. This is the how the secondary market things works. I'm not getting into detail because a lot of people are familiar. Important aspect why we said that from 2026 and beyond, we try to showcase that till 2047, 50, we believe we are very constructive on the precious metal space and silver in particularly more from the gaps which we have seen, and B, it has much more industrial movement, and their prices are relatively better in terms of affordability point of view. Some of the things which we are trying to highlight why it makes sense for the silver perspective. I will stop it here.